Well, price growth in the 12 months to May has slowed more than many were expecting. We've seen the monthly read on inflation on an annual basis come down from 6.8% in April to 5.6% in the 12 months to May. Now, the biggest, offset in the data was a fall in automotive fuel prices. We still are seeing price rises across most categories, though, although the ABS says these are now a little slower than have been in previous months, and in fact this reading of 5.6 is the weakest reading since April last year. We know that inflation in Australia peaked in around the December quarter at 8.4%. So 6 months or so ago, and it has been coming down, although last month's reading did surprise analysts by spiking back up to 6.8%, but it has a lot to do with the volatility of fuel prices and the halving of the excise dropping out of the numbers. So in this month, the most significant price rises were for housing, and we know a lot of that is rents, food and non-alcoholic beverages, along with furnishings and household equipment. The falling Australian dollar may have a little to do with that too. But as I say, the offset was a fall in automotive fuel prices. It was down 8% in the month, which has obviously weighed on these numbers to the downside, I suppose.
What do you think the Reserve Bank is likely to make out of these numbers? Of course, inflation, one of its key indicators when it makes decisions on interest rates.
Yeah, I think the Reserve Bank would probably be relatively pleased to see these numbers. Of course, it's only a monthly reading, and as I've alluded to, the numbers are volatile month to month, and it will be still waiting for the quarterly figures at the end of July to really give a more comprehensive picture about how inflation is going in Australia. But clearly a number with a 5 in front of it is much better than a number with a 6 in front of it. The RBA is tasked with bringing inflation down to its 2 to 3% band. It's not anticipating it will do that until the middle of 2025. 5.6% inflation in Australia is still very high, but no doubt it would be relatively pleased by these numbers. We know that the board at its last meeting in June did consider a pause in interest rate increases, but opted to raise instead because of its concerns around inflation. So this probably at the margins lessens the chance of a rate rise, but the Reserve Bank is looking at a number of factors, and this is only 1 month's reading. But certainly it probably, if anything, adds to the case for them to remain on hold. Whether or not they do is another story. Going into this reading, the market was anticipating a 32% chance that rates would increase next Tuesday. That's likely to change as a result of these numbers. But as I say, these are only bets by the market and 1 month of data, but certainly it does add to the case for them to stay on hold.
Has there been any market reaction?
Yeah, there certainly has. The Australian dollar has dropped reasonably against the greenback as traders bet that there's less of a chance of a rate rise. So it's now sitting at 66.3 US cents. It was sitting a little higher at 66.7 ahead of these numbers. And for the same reason as traders bet more of a chance that the RBA will hold next week, the Australian share market has risen from about 0.7% higher to now 1% higher, Karina.
And just talk to us a little bit more about that target band that the RBA is looking at, that 2 to 3% for inflation, because it keeps telling us about this narrow path that it wants to walk down, lifting rates but still managing to maintain low unemployment as it tries to reach that 2 to 3% inflation target band. The Federal Treasurer this morning was out talking about inflation being likely to remain sticky and persist and not fall within the target band until 2024 to 2025, that financial year. You were saying mid-2025?
Yeah, so the Reserve Bank has signalled that it's likely to meet its target of inflation between 2 and 3% by mid-2025. It's going to take a bit longer than central banks around the world because Phil Lowe really wants to maintain the gains that were made in the labour market during the pandemic. I mean, we have an unemployment rate with a 3 in front of it. It's a near 50-year low, and he doesn't want the unemployment rate to surge. just to bring inflation down. He wants to walk the narrow path of maintaining the gains in the employment market, meaning quite a lot of people still hanging on to their jobs, whilst bringing inflation down. So he's prepared to wait a little bit longer rather than just, I suppose, hiking rates in big moves very quickly. He has been probably, or the board, a little less aggressive, but still it is the fastest rate hiking cycle that we've ever seen. In terms of where the unemployment rate is going to go, if you take what the RBA is forecasting, Michelle Bullock last week, the Deputy Governor, said it's very likely the unemployment rate will have to rise to 4.5% in order to get inflation down to target by that time frame of mid-2025. So there will be losses in the jobs market. There is no doubt that is the cost of bringing inflation down. But certainly the RBA is trying to walk that narrow path, avoid recession, avoid steep unemployment, whilst getting inflation back to target. And it remains to be seen. The path is certainly getting narrower with each rate rise, with many economists now predicting there is a 50% chance of recession in Australia. But certainly these numbers may offer a little comfort today.